Welcome to another video on this channel. As you know, the purpose of this channel is to explain the basic concepts of mutual funds, mutual fund investing, different categories of mutual funds, different options available to investors in a very simple and easy to understand way to investors who are new to the world of investing, especially to the world of mutual funds. My name is Paresh. I am an NISM certified and AMFI registered mutual fund distributor and advisor. This is my ARN number 334516. Today we are going to discuss a very interesting topic, that why long-term orientation is crucial for equity mutual fund investors. So before we go ahead, this disclaimer is mandatory. Mutual fund investments are subject to market risks. You need to read all scheme related documents carefully. The past performance of any mutual fund scheme is not necessarily indicative or guaranteed of future performance of the scheme. Right. So as investors or as prospective investors, you must have heard this term a lot of times, right? That equity investments or equity mutual fund investors need to take a long term view. I have almost always repeated this on this channel whenever I'm covering equity mutual fund categories. uh, so a new investor is always confused that, why should I take a long term view, if a lot of mutual fund schemes have delivered good returns over the last 3 years, typically in excess of say 20%. Why can't I just redeem my units and take that 20% return and go away? See, this is where the short term and long term view comes into picture, right? So this is the short term picture. I have taken the index returns, BSE Sensex returns over the last 1 month. Now if you look at this graph, take some time, pause this video at this time and just take a look at this graph. Now, imagine you are a new investor, and if you are a new investor who is looking to come into the market today, tomorrow, or in the near future, if you look at this graph, you will have many doubts in your mind. See, the graph looks like, overall the market has declined over last 1 month. Uh, it is very volatile. What if I had invested 1 month ago? I would have, probably lost 0.25% of my money. And fair enough. I mean, if even if I had presented you a graph which was like for last 6 months or even YTD, uh, it would have been flat. I mean, the index for the last say 6 to 9 months has mostly been very volatile. The equity market as a whole has been quite volatile, and the returns have mostly been flat. So new investors, when they look at this, or people who had invested just about a year ago, when they see that uh, they have not got any returns, or maybe just marginal return of 1%, 2%, a lot of them might have got negative returns, because some of the categories of mutual fund schemes, or certain specific mutual fund schemes have actually delivered negative returns over the last 6 9 or 12 months. So the question comes into the mind that if this is what I'm looking at, why should I even invest in mutual funds? Or if I'm invested in mutual funds and is showing negative returns, should I just redeem it and cut my losses? Fair enough, logical question. But then let's look at the long term, and this is an excellent graph. Okay, this is how the Indian market has performed over the last say 24-25 years, right? See, all the major geopolitical events, all the major economic events, all the major, even the domestic events have been represented in this graph. So we started, in 2000, 2001, there was a dot-com bubble. The market declined by 26%. Then there was some, domestic politics related events. Then there was the 2008 financial crisis. Uh, the market declined by 33%. Uh, Multiple such events have come, right? So COVID pandemic, the market declined by nearly 40%, right? In a matter of a few days. But look at the overall trend. Okay, let's look at where the market was in March 2000, and let's look at where the market is in March 2024. You will see over a long term the market has grown consistently. There could have been periods of underperformance. There could have been years where the market has actually delivered, a negative return, whether over a calendar year or whether a financial year. But if you had invested in the market in March 2000 and stayed invested in the market, you would have definitely got returns which are in excess of almost any other asset class, right? I think the long term return of the BSE Sensex is around say 14.5%, which is easily more than almost any other asset class in India. So this is the importance of taking a long-term view and not getting influenced by short-term market movements. This is called market noise. In the investment community, or in the investment philosophy, the short-term fluctuations or the news flow which keeps coming in is called noise. Right? You, as an investor, whether you are investing in direct equity or in mutual funds, you need to ignore that noise, right? Because see, this is a 24 years data, and even if you were to kind of go a little back in time and look at the data from say 1990s, this trend still holds. I mean, prior to 2000 also, there were quite a few stock market scams. And, most of you might have heard about the Harshad Mehta scam. That kind of cast doubts on the integrity of the stock markets in India. And these scams keep happening, right? Even today, you'll see a lot of scams. I mean, not at a stock market, at a you know, not at a stock market level, but in individual companies. But remember that despite all these geopolitical events, despite all these domestic politics related events, the Indian stock market has given good return for those who have patience and those who have kept faith in India's economy. See, when you are investing in stock markets, whether it is through mutual funds or through direct equity, you are basically betting on the strength of the country's economy. Right? So if you are investing in Indian stock market, you are basically taking a bet on the future of Indian economy. Right? So if you believe that the future is bright for Indian economy, you can enter the markets, stay invested for a long period of time, and you will be rewarded. So why is equity a long-term asset class? Why not something like real estate, which I think a few years ago was appreciating like 20-25% a year. I know many people who bought flats in Mumbai for 50 lakhs, and within 3-4 years they sold it for 1.25 cr. That's like a nearly a 50-60% return in just 2-3 years. See, investing in equity is not just holding a piece of paper, right? But you are taking a stake in a live running business. Now, understand this. This sounds like a very simple statement, but it's not, right? When you buy, when you invest in, let's say, a fixed deposit, right? You're not taking any stake in the bank. It's a fixed income instrument wherein you are basically lending money to the bank at a certain interest rate, and at the end of the tenure you get your money back and the interest. That's what it is. You're not taking a stake in the bank. Okay, the bank is not going to share its profits with you if you invest in the bank, or if you create a fixed deposit in the bank. But equity is basically you're taking a stake in a live running business, and you are claiming a share of the profits, future profits, I mean. That's what equity investments fundamentally means, right? So there is no guaranteed return, right? Unlike a fixed deposit where you have a fixed rate of return, and there is a maturity date, or an expiry date, and on that date you get back your principal and the interest. There is no guaranteed return. You don't even get your money back, right? If you invest, let's say, 1 lakh rupees in a company share, there is no guarantee that you'll get back those 1 lakh rupees. So the only source of income after you make that investments, or there are two major sources of investment returns or income from that investment. One is obviously the dividend that the company pays you, and secondly is the share price appreciation that you get once you and that share price appreciation is virtual profit. You need to sell that investment to realize that profit. That is also a good point to be remembered. And see, the equity value grows mostly in line with the growth in the company's profits. It's not really a linear relationship. So it's not like, if the company's profits grow by 10%, the share price will go by 10%. In most cases, it might grow slightly more than that, or even slightly lower than that, depending on the market conditions. But over a long term, the share price typically follows the company's growth in profits. And remember, it takes time for a good company to increase its profits, right? Because see, how will a company increase its profits? If you invest in a very good company which is say a mid-sized company, right? The company cannot double its profits overnight, right? Let's say your the company's revenue is 5,000 crores and the net profit is 500 crores, right? 10% net profit ratio is a little aggressive, but anyway, for the example, let's assume that the net profit is 5,000 crores. Sorry, revenue is 5,000 crores and net profit is 500 crores. The company will not be able to grow its profit to say 1,000 crores, okay, the next year. The growth from 500 crores, maybe it will go to 550, then to 600. But in order for the company to grow its profits in an exponential way, not in a linear way, for a few years it might remain flat. It has to invest in new projects. It has to probably invest in new equipment. It has to build new factories, plants, and those investments take time. Right? You can't build a plant overnight, or even in a year in a country like India where the approvals take forever. So it might take time for a company to build a new plant, get all the approvals ready and get the plant running. It might take 3-4 years, but once the plant starts running, the revenues will grow exponentially, and so will the profits. And so that is what equity investing is all about. You're taking a stake in a live business. You're kind of taking a bet that this business will grow in future, depending on what the company strategy is, what the company management thinks about its prospects. So this is a completely different ball game. Equity investing is a completely different ball game, right? So the world's greatest investor, Warren Buffett, okay, has a very long holding period, and the reason he is the richest investor in the world, he's not the richest person in the world, but he's definitely the richest investor in the world, is because he has a reputation of holding on to his investments almost forever. Right. Now he invests in both kinds of business. He invests in listed equities. He also invests in unlisted equities. Right. So these are basically private businesses where he just buys them out. I mean, most of the times he probably takes a stake in excess of 80% in unlisted businesses, and then he just doesn't let it go. He will just run those businesses forever. Those businesses will keep on generating profits and dividends for him as in not him personally, but for his investment vehicle, which is called the Berkshire Hathaway. It's a fantastic a mechanism. If you haven't read about Warren Buffett, I suggest you actually do some research on how Warren Buffett has been able to consistently beat the index performance. And these are couple of his quotes. Okay, the first one is that our favorite holding is forever. The second is that if you're not willing to own a stock for 10 years, do not even think about owning it for 10 minutes. This is all long term orientation. And this is not fluff. This is not something PR. He actually lives by what he speaks. And that is why he has such a stellar reputation when it comes to investing. And this is why I'm saying he actually lives by what he says. These are some of his longest held positions. These are listed equities. Okay, so look at American Express, 31-year holding period. I'm talking about the holding period, right? 31 years, 36 years, 14 years. Can you imagine somebody investing in a company and just holding it for 36 years? And that is why Warren Buffett has been able to generate such phenomenal returns. Like, look at the investment, 1.3 billion investment translated into 45. That's nearly 40 times, no, 40 times the multiplier effect, right? So this is what it is about. Equity investments are inherently long term in nature. So, whether you're investing in direct equity or whether you're investing in equity mutual funds, you need to have a very, very long term horizon for you to get a good rate of return. Now, this is another very good advice from Peter Lynch. Peter Lynch is the world's most successful mutual fund manager. He managed the Magellan Fund uh, of Fidelity for 13 years in America. This is an American mutual fund, and he delivered a stellar return of 29.2%, average annualized return of 29.2% over 13 years in American stock markets is nothing short of a miracle. And he beat the S&P 500 index by twice. So the average annualized return of the S&P 500 index during that period was somewhere close to 15%, but his fund delivered 29.2% over that period. That is a fantastic rate of return. There is no other mutual fund, actively managed mutual fund in the history of the world, not just in America, but anywhere else in the world that has delivered these kind of returns. So when he is giving you advice about how to pick the right mutual fund and how to stay invested in mutual funds, this is something to be taken very, very seriously. So I suggest you pause this slide at this point and read this advice clearly. I have actually done a video on on Peter Lynch's investment philosophy and whatever advice that he has for stock market as well as mutual fund investors. That video is a must watch. If you have not watched it, I suggest you go back to the channel and watch that video. Right. So see, what Mr. Lynch says is that, okay, picking future winners from past performance doesn't seem to work even when you use a 3 or 5 year record. And here he is talking about mutual funds, picking the right mutual fund schemes, right? So what he's saying is that this is not to say that you should not pick a fund with a good long-term record, but it is better to stick with a steady and consistent performer than to move in and out of funds trying to catch the waves. What does that mean? You need to do your homework before you invest, right? Look at the fund's investment philosophy, look at its track record over a long period. Don't look at just 3 or 5 year record, and look at how stable and consistent performer the fund has been. How do you look at how do you do that? There is enough material available online. There is a website called as moneycontrol.com. There is value research. You can go to the fund's website, look at its returns history. uh, so basically, what he also suggests, Peter Lynch also suggests that you also need to look at what happens to funds in a bear market. Bear market means what? When the market is falling. See, when the market is falling, there are only three ways a fund can behave. Okay, some funds will lose more than in others or the market, but gain more on the rebound. So let's say the market has declined by 10%, maybe the fund's returns decline by 15%. But when the market increases by 10%, the fund will also give more returns. So its returns will probably be more than 10%. That is a good fund. Or these are okay kind of funds that you can think about investing in them. The second fund is that some lose less but gain less. So if the market falls by 10%, maybe these funds will fall by 5%. But when the market increases by 10%, they will also kind of not increase more than 10%. They'll probably increase by 5%, 6%. These funds are typically conservative mutual funds, and they are also okay. But then there is a third type of or third category of funds. Okay, they lose more but gain less. Right. So when the market declines by 10%, they will uh, decline by maybe 15%, 20%. But when the market gains by 10%, they will gain by maybe 5 or 6%. Now, these are the category of funds that Peter Lynch advises you to avoid. So this is a very good advice. I suggest you pause this video, read this again, and there is this video, another video on this channel, which I have done exclusively on Mr. Lynch's investment style and investment advice. Right. So what is the entire gist of it then? Entire gist of this entire anecdotes as well as historical data, that choose the right schemes and then let time work in your favor. Don't so not and remember, not every mutual fund scheme is right for everyone, and this is where the role of a mutual fund advisor is important. If you do not know about how mutual funds work, or what are the different types of schemes and categories, you need to go to a good mutual fund advisor, right? And that mutual fund advisor can help you select the right schemes that best fit your investment objective, goal amount, risk profile, and investment horizon. Don't be alarmed by short-term market movements. Don't If you read headlines like the Sensex declines by 1,000 points, uh, do not immediately go to your portfolio and see how much your portfolio has declined. Right? Don't check your portfolio NAVs on a daily basis. That is another good practice. Uh, Maybe do a quarterly review of your portfolio, and if you have any concerns or queries, if you see suddenly your portfolio or certain schemes have declined drastically, then maybe you can go back to your advisor. But remember, if you have done your homework, right, if you have understood the scheme's investment objectives, its investment framework, and if you are satisfied with the fund's track record, you should invest your money and just let the time work in your favor. Let the fund manager do his or her job. And this is a very good illustration. So this is from this is the performance of HDFC FlexiCap fund. And note that this is only for illustration purpose. I'm not This is not an investment recommendation. I'm not saying that you should immediately go and buy HDFC FlexiCap fund. Obviously it's a good scheme, but it may not suit everyone's investment objective. So see the performance, right? So if you had invested 1 lakh rupees in HDFC FlexiCap fund at inception, which was in Jan 1995, and just forgotten about it, okay, the fund as well as the market, the Indian market has gone through many ups and downs, many scams. You see the dot-com bubble, the global financial crisis, the Satyam scam, Russia-Ukraine war, COVID-19. If you had just invested 1 lakh rupees in this fund in 1995, Jan 1995, and just forgotten about it completely, okay, today in 2025 your investment, that 1 lakh rupees, would have become nearly 2 cr. The fund has delivered an annualized return CAGR of around 19% for the last nearly 30 years, right? While the index, or the Nifty 500 has delivered a return of around 12.6%. So this is the importance of having a long-term orientation in the stock markets, whether you are investing in direct equity or through mutual funds. And this is the importance of just ignoring all the short term noise, and let your money and the time and the compounding work in your favor. I don't think there's any better example of showing the importance of having a long term orientation and patience in the stock market. uh, Note that there are many other schemes, okay, which are just as good, and which have been probably existing for just as long. I just given this an example. Again, I'm repeating this. This is only for illustration purpose. I'm sure there are many other schemes who have given similar returns over such a long period. So that was about the importance of having a long-term orientation in as a mutual fund investor. If you are looking to start your investment journey, you can contact me on this WhatsApp number 9757309269. I can definitely help you in selecting the right schemes which best fit your investment horizon, goal amount, and risk profile. There is a QR code on the right. You can scan this using your mobile phone camera and download the Funds Bazaar app. If you're not comfortable using the app, you can go to the link given in the video description, and go to the Funds Bazaar website, register yourself, and you can invest online in any mutual fund scheme from that website. Thank you for watching this video. Don't forget to subscribe to this channel. We will be covering many interesting points about mutual fund investments in future videos. Thank you.